Today, I'm going to talk about BCE stock. It's down big after news of a big acquisition broke yesterday that has ramifications for both its growth prospects and its dividend. So now the stock is trading at a 52-week low, and it hasn't been this cheap since 2012. So is it worth taking a chance on it? So this is what the acquisition is. A $3.6 billion US deal to acquire Ziply. So this is a US company. It's an internet provider in the Pacific Northwest. It has locations in Washington, Oregon, Idaho, and Montana, and it's expanding in the years ahead as well. So it's a bit of a growth opportunity for BCE. And BCE is typically not much of a growth stock. It's a bit of a slow-growing business focusing on just the Canadian market. So this is a stock that investors have typically bought for its dividend, and its growing dividend. And that's another reason why investors aren't so thrilled with the stock right now, because BCE is saying it's ruling out any increases to the dividend for all of 2025. So effectively, it's breaking a streak of 16 years of increasing its payouts. So that's the big headline for dividend investors, that their dividend income isn't going to rise. And when it's going to resume, or if it's going to resume, is a big question mark. So this news of an acquisition comes less than 2 months after BCE talked about getting rid of its stake in Maple Leaf Sports and Entertainment, selling that to Rogers for $4.7 billion. So effectively, this puts it in a similar situation to where it was before that announcement, because it's going to take that money to help fund this deal, and so it's not going to use it to reduce debt like it said before. And so that's another reason why investors are concerned, because now the debt load is going to remain an issue, and on top of that, the dividend isn't going to be growing. So there's a lot of uncertainty with BCE now that didn't exist just a few days ago. If we look at the company's financials, you can see year over year, there's not a whole lot of growth. It's a basically slow-growing business. Its profits have been declining a little bit, but overall, it's made for a stable buy over the long term. Primarily, if you're investing in BCE, it's for its dividend. Now, with this sell-off, the stock is trading at a forward price earnings multiple of 13, so that's a lot cheaper than in the past. You can see back in June of 2023, it was up around 19. So fairly cheaper stock to buy, obviously, especially with it being at a 12-year low. Now, with the drop in price, the dividend has actually increased now to around 10%, obviously because now the stock is lower. It's still paying the same dividend, even though it may not be planning to grow it. Investors who buy the stock today can still get a really high yield with BCE. But the big question is what happens with that dividend. In my previous video, I talked about how, due to BCE's high payout ratio, the prospects for growing its dividend may not be all that great, and even if it does increase it, it may be a modest amount. So with this latest news, it's saying it's actually going to be suspending those increases and stopping them entirely in 2025. It made no promises of resuming them afterwards. And in all likelihood, it's going to take some time to figure out how it's integrating that Ziply business into its operations, how it's growing, whether Ziply is going to need some cash infusions to help grow and expand as well. So there's still a lot of question marks right now, and it's too early to tell whether even this dividend is going to be safe. Because now that BCE's broken its streak, what I expect is going to happen is it's going to cut its dividend. And it might happen next year, maybe in a couple years. But now that it's broken its streak, there's really no reason to not cut its dividend, because there's a lot more reasons to do it than to not do. One, it will reduce its debt load. Two, it's going to free up a lot of cash. So whether it wants to use that for Ziply or for maybe another acquisition, who knows? It's going to free up a lot of cash flow for the company. And a third reason is that right now the stock is paying 10%, right? It's a very high yield. And normally, if you look at dividend stocks that pay 10% or more, one of the first things you're probably going to be thinking about is that yield is probably too good to be true, or there's something wrong with the company if its yield is that high, because that means the stock is not rising, that investors are a bit hesitant to invest in the business. And so from a management point of view, their management might be thinking, even if we cut the dividend in half, it'll be yielding 5%, still a very good rate, but it won't be raising as many red flags with investors, because at 5% they'll think that's a reasonable payout for a telecom company. You look at AT&T, Verizon, they're around the 5%, 6% range. So BCE being around there, could be justifiable. And so for people who haven't been tracking the stock or following it and realizing that it cut its dividend, they might think that, okay, that's just fine. It's a good yield, especially if you're buying it now. For investors who've been holding it and see their dividend get cut, then obviously that's a different story. But that's why I think there's a lot of reasons why management may consider cutting the dividend, because now that that dividend growth streak is broken, they can still maintain that they've been paying a dividend since such and such a year, but with no incentive to worry about whether that streak is continuing, because they're going to start from zero at some point. It's going to be a lot easier for them to justify cutting that payout, especially with the yield being as high as it is. So I wouldn't be surprised if that's the next move for BCE. It's just a matter of when that happens. But even though the company said it's pausing its dividend in 2025, the main thing to be wary of is that, there's no promises as to when that dividend growth will resume again or when it will start up. Odds are, I would suspect that it's going to take some time, might be a couple of years, for it to figure out, what's a dividend that it can feel it can support, while also supporting Ziply and its growth prospects in the US, because this may be a bit of a shift in strategy for BCE to go away from growing its dividend and maybe focusing more on growth, just to get that stock price up and rising, because it's struggling for a while now. Unfortunately, this latest news isn't helping, but if it attracts more growth investors in the process, then it could be a win in the long term. And so if you're thinking about buying BCE for the dividend right now, I wouldn't get too attached to it, just because there's still a lot of question marks right now. It's way too early to know whether this is going to be a sustainable payout. But is a stock worth investing in? That's the big question. And right now, I would hold off on buying it. I would wait to see how it does in the next few weeks, because oftentimes when there's a big sell-off, that sell-off the stock continues to trickle down in the weeks, maybe in months afterwards, especially as it releases earnings numbers, maybe updates its guidance, lowers that guidance. And so I wouldn't be surprised if it's still going to go lower after this. It's got earnings coming up this week, so there could still be a lot more bad news that sends the stock even lower. But at the very least, I would wait to see if it falls lower, because right now there's still a lot of risk with the stock, and I wouldn't assume that just because it says it's only pausing the dividend, that a dividend cut may not be around the corner, because that could be the next big move BCE takes.